So welcome to Procom's Facebook Live. We're live here with Andrew. So we're actually going for the first time live over 2 video streams. So we'll be on Andrew Wall's page, and he'll be sharing that out to the CA4IT page later today.
Yep.
We're also live on the Procom site. And today we're talking about something that Andrew's definitely the expert in, and I'm just here to moderate and listen to Andrew talk about tax tips, HST, and everything to do with what's going on in your financial situation today with RSPs. Courtney, we're trying to reconnect.
Tax-free savings account.
Tax-free savings account and everything there. So, to start with, why don't we talk, Andrew, about, at this time of the year, what are we doing as an average employee, as an incorporated person, and a sole proprietor? What do you need to do, as we're getting into that tax season,
Right.
To be better situated?
Well, we are coming up to the deadline for RSP contributions, which is the big topic on everyone's mind these days. How much should I contribute to my RSPs? Should I contribute to my RSPs, my TFSAs, my RESPs? And if so, how much? So that's the big question on most people's minds right now. And it is very different for independent contractors than it is for full-time employees. When you're a full-time employee, you're usually at a much higher tax bracket than an independent contractor, because one of the great things of being self-employed is the ability to leave money in your corporation and therefore have a lower salary. But there's still a fit and a place for RSP contributions for independent contractors. And I think the question becomes how much, and this is a question I encourage you guys to have, or a discussion I encourage you guys to have with your accountant, who's going to know more about their personal situation. But I can give you some high-level rules. First of all, if you're below $43,000 or $45,000, there's no point in making an RSP contribution, because you're into the lowest tax bracket, and when you're at the lowest tax bracket, the best thing that you're getting with an RSP is a deferral. So you're not going to pay any tax today, but you will pay tax when you're in your 70s and you're forced into RIF, when you have to take money out at basically about 5% of whatever the value is of your RSPs at that time per year. So the best case scenario there is that you have saved money at the lowest tax bracket, and in retirement you're taking money out of your RSPs at the lowest tax bracket. But there is the possibility that you could even be into a higher tax bracket if you've saved a lot of money in your RSPs and potentially have adversely affected yourself rather than created a tax advantage. So the tax advantage comes by contributing into your RSPs when you're at the higher tax brackets. So if you're an employee, high income, it's a no-brainer. If you're self-employed and you're in the lower middle tax brackets, it becomes a tougher decision. And where we then look at is other alternatives like tax-free savings account, which are an incredible vehicle. They grow tax-free. They're almost the polar opposite of an RRSP. So an RRSP, it reduces your taxable income today, and it goes inside of an RRSP, and you don't pay tax on any of the growth now, but when you take money out of the RRSP, you do pay tax on the growth at that point. So with the TFSA, you do not reduce your taxable income today. That money is money that you have been taxed at, but any growth that tax-free savings account accrues grows completely tax-free. In addition, one of the nice things about the tax-free savings account is if you have to take the money out for any reason, you're not taxed on that money when you take it out, because it's already been taxed. And in addition, if you wait a year, you can put the money back in. And this is a really great tool when you have or want an emergency reserve fund for, you might need a roof down the road, or there might be emergencies that you haven't thought of. Tax-free savings account is a great tool to have that emergency reserve fund in, because you can take the money out and then put it back in without basically having any penalties.
So tax-free savings accounts have been around for a while now. So if I haven't started a tax-free savings account, can I start it and get the benefit of all the years I haven't contributed, similar to my RSP, or do I have to start with just this year and move forward?
No, absolutely. You get the benefit since it was created, which is great. So it's built up to quite a bit of money at this point that you can contribute. And again, it's also not based off of your income. There's a set amount for every Canadian, regardless of your income. And again, RSP is a function of your income. You get 18% of whatever your income was. Are we okay?
Yeah, we're good.
We're good, because I think we see a red.
Procom, our Wi-Fi are having issues, so it's not working for us, but everyone can still watch on your feed.
Excellent.
And I made a note on Procom's website so they can
jump
into yours. Yeah.
Hopefully they figure it out.
Great, and we'll get a copy of yours and share it out on our Facebook page a little bit later.
Absolutely.
Okay, well that's a great tax tip right there in terms of tax-free savings account. Now, is it something that you might want to consider doing both things as an individual, looking at your RRSPs and your tax-free savings account and trying to maximize the benefits of both?
Absolutely, and in fact, usually when we're working with our clients, we do a personal net worth assessment on every single one of our clients as part of our year-end review. We look at how much money they have now, how much money they want to have in retirement, and what that translates to as far as goals that they need to set for each year until they reach retirement. And when we look at that, we're not looking at just inside their corporation or just inside their RSP. We look at it holistically. So we ideally want people having money in a multitude of places. We want them to have money inside their corporation. We want them to have money inside RSPs. We want them to have money inside tax-free savings account. And depending upon their income level, even sometimes personally unregistered investments. So there should be a multitude of places, because the more places that you have money, the more flexibility that you have in your retirement planning and being able to draw money out from different places when it makes sense. Because if you've built up all your money inside of an RRSP, again, this could be problematic depending on how much you built up, because of the RIF scenario where you have to take 5%. And you could potentially force yourself into having to take more money than you need, simply because you put all of your money into one place, your RRSP. So we like to have a multitude of sources so that we can be flexible in our planning.
Okay, that's great tips. Now, what about the RESP? Obviously, there's not any tax advantages to that, but what is your thoughts on the RESPs?
The RESPs, I think, are one of the most underutilized tools. And I've got a slightly aggressive tip on this that can basically provide free money. And that tip is that we've got many of my clients who have real estate accrued a lot over the last few years. It's built up a lot of value, and that money can be used towards your RESPs in a bulk lump sum contribution. And what a lot of people don't realize is they think that they can only make the $2,500 contribution each year, which gives you the maximum return for the payback from the government. But you can actually make the total $50,000 contribution up front, and then not make contributions each year. Now, what will happen is each year for the next 20 years, you'll get that payment for the government based on the $2,500 maximum contribution per child. But now it's into an investment where it's growing and it's compounding. And even if you had to borrow that money from the equity that you have in your house, even let's assume right now, in the worst case scenario, that you're going to generate the same rate of return inside your investments as you would your borrowing costs, which is actually probably unrealistic, because I can tell you, you can go and get a mortgage from BMO right now for less than 2% on a variable rate, and then walk in and invest it in the same bank and get a dividend yield of 4%. But let's go with a narrow conservative approach that you're going to get the same rate of return. Well, you can actually invest that, and because the investment is going to grow compounded, it's going to have actually a greater return for you than your cost, even if the cost was the same 2%, because you're going to be paying simple interest versus compounded interest as far as growth. So there's free money there for those people who are willing to pull money out of their equity that they built in their house and make a lump sum contribution into the RESPs. So it's not for everybody. I recognize that it's, some people have been raised that the fastest path to financial freedom is paying off their house, which I fundamentally disagree with. I apologize for standing on my soapbox here for a minute, but I think that there's so many of us that grew up with our grandparents and our parents telling us, pay off your house, pay off your house. But that was back when our parents had double-digit interest rates. We have the lowest interest rates we've ever seen in history. And this is a great opportunity to use the bank's money to make money. And I think that that's an opportunity that a lot of people are missing out on. I think you have to be careful not to overextend yourself and over-leverage yourself. I mean, an interesting story I share, and Dad, I hope you don't mind me sharing this, but my dad has been successful multiple times in his life, but he's also had his failures. And one of his biggest failures was back in the late 70s, early 80s, he had millions of dollars worth of real estate and over-leveraged, and interest rates doubled overnight, and they put in rent controls, and he went bankrupt. So it's a fine line. You don't want to overextend yourself, but you don't want to miss out on this opportunity to leverage this very cheap borrowing.
So if you had the opportunity to pay off your mortgage and you're sitting here thinking, okay, I've already paid off my mortgage, maybe now is a good time to take out, $20,000, $30,000, $40,000 against your mortgage, put it into your ESP, because you know those education costs are only rising. As much as your house price is rising, education prices are also rising, to put that money away for your kids at a later time.
Absolutely. So it's an investment, and I think it's an investment that's going to generate free money for you. That's a great opportunity. And I think the other thing, too, is that for independent contractors, this is a strategy that can work for employees or independent contractors. But for independent contractors, there's the added boost that you've got your home office deduction, and your home office deduction, you get to take a percentage of your mortgage interest. So if you have a higher mortgage, then you have higher mortgage interest, and you'll have a higher deduction.
So it also helps your anyone who has that independent contractor status as well, doubly.
Now gets an extra benefit of a greater tax deduction on their corporate taxes as well.
Well, and also if you've already paid off your house and you're not taking advantage at all of any mortgage interest into your business, this is an opportunity to also reduce your corporate taxation then.
Absolutely, and I think that, again, I've seen this so many times, where people are pulling money out of their corporation to pay down their home, their mortgage, aggressively, and that's, I think, one of the biggest mistakes I see, because when you take money out of your corporation, that money is going to become income to you, either in the form of a dividend or a salary, but it's going to become income to you, and that's going to push you into higher tax brackets. And because of the marginal tax system, the more money you take out, the higher the taxes that you're going to pay. And I think that does bring up another really important discussion that I think for my clients, we've had this discussion probably early November, December, when we were trying to figure out the tax planning for the year. But understanding the difference between salary versus dividend, and when to choose one over the other. This is a question I get all the time, and I think some people understand certain components of it, and some people get it completely, so I apologize for the audience that does understand it, but they are very, very different in how they're treated, and there's advantages and disadvantages of each. Generally speaking, we recommend for our clients that they take a salary during their income earning years, and we like salaries because they are eligible for RSP room, and they are also eligible for CPP. And this is where the debate comes in, because CPP is not a tax, it's a Canada pension plan. But some people don't believe in Canada Pension Plan. They're worried that when they reach retirement age that it won't be there for them. I don't believe that. I don't think the rate of return on CPP is terribly great. I think you could probably do a better return on your own investments, but it is a guaranteed rate of return. So there's going to be something there for you in retirement, whereas if you opt to take dividend and don't contribute to your CPP, and then choose to take that money and invest it yourself, there's the possibility that you could lose that money. That is a risk that you run with the markets if you choose to invest in them. So for that reason, we do value CPP. Now, dividends do make an effective strategy for income splitting with spouses and children, particularly if we can't justify an involvement in the business. If we can justify an involvement in the business, then we can pay them a salary as well. But there is a reasonableness test that must be passed for anyone we're paying a salary to. With the dividend, there is no reasonableness test. So as long as they're a shareholder, we can issue shares to them in any amount. Now, one of the key things is making sure the share structure of the corporation is done properly from day one. And unfortunately, we see way too many people that go out and do the
Online incorporation?
Online incorporation. They do it federally. They set up a corporation the way I set up software. Yes, 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 which is the worst thing that you could possibly do. So I'm not in IT, and you shouldn't be in accounting. So, seek out a professional to help you get that structured correctly, because it's going to cost you a lot if you get it wrong.
So, so to level set, if I set up an incorporation and I did do it like online and I went yes, 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 and like I've been running my incorporation now for several years, and you're telling me there's a better way that I'm going to save money, what do I do now, to fix my issues that I might have set up that are costing me possibly thousands of dollars every year?
Yeah, it gets complicated. It really depends on the situation, and I hate to say that.
I knew you were going to say that. I knew this is your path thing. Everyone's situation is a little bit different, so come see somebody.
come talk to a professional. But If you have no retained earnings, it can probably be changed fairly easily. Retained earnings are the money that's left inside the corporation after you pay taxes. If you do have retained earnings, it's not that it can't be done, it gets a little bit more complicated. We have to do asset freezes and rollovers because basically if you want to change the share structure of an organization, it's not that simple. And sometimes if you've got a lot of retained earnings, it becomes easier to set up a whole new company and then have that existing company fade out over time by taking your existing salary for the next couple of years out of that company and then growing your equity in this new company that's structured properly. And again, come and have a discussion with us, a free consultation, and we'll figure out what's best for you if you think you've done it wrong. But again, I hate saying it, but everyone's situation is different, and you really need to seek professional advice on that.
Okay, and so what if I don't know? Like, what if I don't know if I've set it up wrong? Should I just, is the best course of action, go see a professional, get them to look at your incorporation documents and how you set it up and your last few years of filings to see if there was savings available to me and what I should be doing next?
Yeah, well, one of the things that we'll offer is we offer a free benchmarking analysis, which will show you how you compare to the average and the median in our database. And this will identify areas where either you've maybe been more aggressive than you should, and you're potentially at risk, which does happen. But more often than not, it's the other way around. It's people who have missed out on deductions that they're not aware of. And so our benchmark will help pinpoint where you're above and below both the average and the median in our database. And our database, we've been doing this for over 30 years now, specializing specifically in this industry. So I would argue that we have the best database in the industry, even better than CRA's, because CRA obviously has a fantastic database, but they don't segregate it into as narrow a niche as we do. So they've got such aggregate data that when you get benchmarked by their systems, you're getting benchmarked against consulting companies that are 10 times your size.
So people not in the industry, your database is really like the independent IT consultant who is like 1 to 2 people within their company.
Absolutely. I mean, that's the area that we've been focusing on, is these owner-managed businesses that are really micro, if not nano, businesses on CRA's definition of what a small business is. So, you want to seek a professional that knows and understands your field, and I don't think there's anyone in this industry that knows it better than us.
Okay, great.
Sorry for the shameless self-promotion.
Hey, that's what this is all about, is, obviously as individuals, we have IT consultants out there. They're definitely not tax professionals, and I think this is why people seek information like this, is that everybody wants to save money, whether it's $100 a month or thousands of dollars every year. People are looking for definitely ways that they can, cheat the tax man.
and on that note, I do have, another way that people can save a little bit of money. I've got a special offer, as I mentioned to you earlier. Unfortunately, it's only for the first 20 people that email me. You can email me at a.wall@ca4it.com. Again, that's a.wall@ca4it.com. And the offer is compliments of Intuit. I can provide the first 20 people a discounted wholesale pricing on QuickBooks Online. So that's 45% off the retail, which is better than any other pricing out there right now. Plus, on top of that, I can give you 6 months free HubDoc, which is a great tool. It's a Canadian-based company here that allows you to snap a picture of a receipt with your phone or your smartphone, and that automatically goes into QuickBooks. The data's captured and converted into a transaction for you, and can make your bookkeeping a breeze. And the key to maximizing these deductions is documentation. So if you've got all your information being tracked and pushed into QuickBooks Online, it becomes really easy to be able to maximize those deductions, because even if you've categorized them as what you a corporate debit card and a corporate credit card, and put everything on them. And if you're not sure whether it's deductible or not, we have a category called Ask My Accountant. You can put it under there, and we'll review that with you at the end of the year. But the worst thing that you can do is take a deduction and throw it in the garbage because you didn't think it was deductible. I always want you to have that conversation with me to make sure that we can maximize that deduction.
So you mean by snapping pictures of my receipts instead of shoving them in my glove compartment or my my console, that's probably not the best place for them?
Absolutely, because one of the things that a lot of people don't realize, I think more and more people are becoming aware of it, is those receipts fade over time. So
Yes, they're blank.
yeah, you come back to them and they're not legible. So snap a picture with your phone. Again, even if you're not using HubDoc, which is an amazing tool, or QuickBooks Online, your phone is your best tool for accounting and bookkeeping in the world. You can take a picture of it, keep it as a record, and then if you want to go back and put it through one of these systems later, you could, but at least you have the digital document. And it's not a hard habit to get into. It's just every single time that you make a purchase, take a picture, and that's your bookkeeping. You know, nothing is simpler.
Good idea. Good idea.
We have a bunch of questions. Do you guys want to wait till the end, or?
I'm happy to
So
field
yeah, why don't we field
Yeah.
some questions now?
Okay, so one question is, how often do I remit my HST, CPP, and EI premiums to the CRA?
Okay, well, those are very different things. So HST will depend on whether you're quarterly or annually filed. For our clients, we encourage everyone to register as, for most independent contractors, as quick method and annual filers. And again, what's my tagline? Everyone's situation is different. Come talk to a professional. But usually it's you're filing once a year, and that deadline will be 3 months after your corporate year end for your GST. Now, source deductions, which are CPP and the taxes on your salary. For independent contractors, there's no EI. You can opt into it. As a small business owner, we don't recommend that because the return isn't very good. But for your CPP, it could be monthly, quarterly, or annually. Again, for many of our clients, they do it annually, where they pay themselves a bonus once a year, and they only remit their taxes to the government once a year, which for us just passed. It was January either 3rd, 10th, or 15th. Source deductions are by far the most complicated thing, and you really need to speak with a professional about it, because if you're taking money out of your business and it's considered salary, then the government will expect you to pay taxes on that when you take the money out, unless it's being taken out for a loan or for purposes for the business. So you have to be very careful on how you set up everything and structure it, but there are ways to pay it only once a year. There are ways to pay it every 2 weeks. There are ways to pay it once a month. There are ways to pay it every 3 months. And then depending upon how much you're paying, it could be due either the 3rd of the month, the 10th of the month, or the 15th of the month. So it is a very complicated thing. On our YouTube channel, we have a video called Source Deductions, which goes through the different thresholds. It's an hour-long video. I can't do it justice here. I encourage everyone to go to our CA4IT YouTube channel, have a look at our source deductions video, and that'll give you an introduction onto
And
the
you know what?
deductions.
We'll make sure that we share that YouTube video out on our Facebook page as well, just to share it out to everybody. So because obviously, as you're saying, it's pretty complex, and we obviously don't have an extra hour to talk about it.
Yes.
So another question we have is, how do I pay myself from my incorporated company?
So somewhat related to the last question, because when you pay yourself, you're going to have to pay taxes. If you opt to take your payment as a dividend, you take your money out, and at the end of the year, you issue a T5 or a dividend slip, and that actually has to be created by the end of February. Now, if you're taking your income in the form of a dividend, you don't pay any taxes until you file your tax return in April, and you basically say, here's my T5 slip, here's the dividends I received, and then you're then taxed on the dividends that you earned. And if you take a salary, it's very different. The salary is just like a salary of an employee. If you're paid every month, CRA expects you to remit their portion to them every single month. If you're paid once a year as a bonus, which is an option, and again, I encourage people to talk with a professional about how you do it, you would take money out, and then you would remit your share of that taxes to the government by either the 3rd, the 10th, or the 15th of the following month. But it's pretty straightforward as far as being able to pick which strategy you want to do, and then just take money out of your corporation. And if you're a dividend, there's nothing to do other than declare the dividend at the end of the year. If you're doing a salary, then there are potentially payroll contributions that you would need to make. So talk with your professional about that. Or again, there are other ways to take it out as a loan. But again, this gets far more complicated, and in that situation, you definitely need to speak to a professional.
And can I take dividends multiple times through the year, or do I only take it, I can only take it once?
No, you can do multiple dividends throughout the year. It's obviously far easier if you do it at set times, because dividends are based on a cash basis. So when the dividends are distributed is when they're recorded, and you have to be very careful because your year-end is unlikely to have a December year-end. Many people do, but lots of people don't. And so you can have dividends that fall into one calendar year or the other. And so you have to be very careful of reporting that correctly. And obviously if you're working with an accountant, they'll make sure that that's done. I don't encourage anyone to prepare their own T4s or T5s. I've seen many people make a big mistake out of, particularly with T5s, which are for the dividends, because there's eligible and non-eligible dividends. And if you do it yourself, it is non-eligible dividends for small businesses. But we've seen people make big mistakes out of that, and that could be, it'll pretty much guarantee to trigger
an audit.
Yeah, a payroll audit, which may or may not lead to a general audit. Depending upon how.
Anytime someone says the word CRA audit, it gives me nightmares. So
yeah, you've got to be, payroll in particular, payroll and GST are trust accounts. This means that money is not the small business owners, and so you have to be very careful because the government gets very finicky about payroll deductions and GST deductions, and if you don't make them, they will penalize you quite significantly, and they will freeze your bank accounts. And we've seen that happen many times.
So we have another question. My year end is June 30th. Do I submit my business taxes on June 15th?
No. You have 3 months after your year end before your corporate taxes due, assuming you're a small business owner. And again, I don't know this individual situation, but for most independent contractors who are small businesses, they have 3 months after their year end to submit their corporate taxes and their GST. From 0 to 3 months, there's no interest and no penalties. After 3 months, the corporate taxes begin to accrue interest, but no penalty, and the GST accrues a penalty and interest at that point. For the corporate taxes, you actually get another deadline, which is another 3 months out, or a total of 6 months after your year end. And 6 months after your year end, if you haven't filed and you haven't paid, they start to charge you interest plus penalties. Now, the good news on all of these deadlines is that they're all a percentage of what's outstanding. So if you made all your payments by that 3 month deadline, even if you haven't filed, it's a bit of a misnomer. Yes, there's a penalty, but the penalty is of what's outstanding. If there's nothing outstanding, the penalty is 0.
So it's sort of like if you don't owe anything to the government on April 30th
and you don't file,
it's like, okay, there's a penalty to that, but the penalty is 0.
And that's exactly the same. So the deadline is 3 months after your year end, your corporate year end, and that would mean that ideally we'd love to see clients. If you were a June 30th year end and you brought it to me July 1st, I'd be dancing for joy. And unfortunately, clients don't do that. They tend to bring it, the end of September
30th, and be like, here.
There you go. Yeah, can you do this in 2 days? No, sorry, I can't. But yeah, you do have a bit of time. For us, we usually say it takes 4 to 6 weeks turnaround time. And the thing is about accounting, and unfortunately, this is the same with all accountants, it depends. We don't know when our clients are going to drop off our work. So we say 4 to 6 weeks because sometimes we can do it in a week or two. If no one's dropped in their stuff and you happen to be the first person of that month, which is unlikely. But oftentimes people seem to wait till the last day of the month, and then we have everyone dropping everything off at the same time, and we've got to work through that workload. So I hope clients understand that we want you to bring in that information as quickly as possible.
And we have one last question so far. If I don't collect salary from my incorporated company, do I need to declare any income for April 30th?
If you haven't taken any salary, you don't have to declare any income. And in fact, you're probably beyond the point of being able to claim salary for the 2016 tax year. If you were going to do a salary for the 2016 tax year, you're now at the position where you would be late in making your source deduction remittances, which would have been due at the absolute latest of January 15th. So if you haven't already done that, made a remittance, I don't encourage you to do a salary at this point. If you have taken no money out of your corporation, there's no obligation to take a salary or a dividend. If you have taken money out of your corporation but neglected to take or make a source deduction contribution, you actually still have time to take it as a dividend, and you can prepare your dividend by the end of February, and you won't have any penalties.
Okay. So probably some of the things that, one of the questions I wanted to ask is, there's probably common expenses that people don't take, and then there's probably expenses that people do take that are probably questionable. What would you say the most forgotten expense would be that people just don't claim as part of their business?
It's small, but it gets neglected all the time, is in regards to office supplies, it's the little things like garbage bags, cleaning supplies for your offices, all those little things that people think, oh, well, it's a couple bucks here and there, and I'll just add it onto my grocery bill and toss the grocery bill and not include it. But that can add up to, on average, it's about $700 to $800 for our clients. And that's probably the most often overlooked, as well as books and periodicals. I know more people are getting their content online these days. I recognize that. But any reading that's being done, digital books, magazines, subscriptions, newspapers, those often get overlooked. There's a lot of deductions that our benchmark tends to trigger. Those are most often overlooked. But there's lots that people miss out on. Meals and entertainment is one where people usually claim something, but certainly not as much as we believe that they're entitled to. Because as a small business owner, you're constantly networking, you're constantly building relationships. And all of that networking is there to help your business grow and is therefore legitimately deductible business expenses. And particularly if you've come from an employment background, the assumption is, well, if I'm going out with my friend, this can't possibly be deductible. Well, can that friend help you find a job in the future? Are you guys talking about things related to, peers and coworkers and projects that you've worked on? Probably. What about going for dinner with your wife? I can't possibly deduct a meal with my wife. Yeah, she's your most trusted advisor. I don't know many men that make financial decisions without their, or if they do, they're
in trouble.
They're in trouble. I guess it's either beg for forgiveness or ask for permission, right? Sometimes it's easy to beg for forgiveness, but the reality is your partner, whether it's your wife or your husband, is your most trusted advisor. These are the people that are providing value to you in your business and providing guidance, providing value to you in understanding finances, providing value to you in helping you build greater relationships. And so that's all business related. And we want to open our mind's eye to this concept of being entrepreneurs, and particularly for those people who come from the employment background and don't recognize themselves yet as an entrepreneur. It's really important to flip that switch and recognize that you are a small business owner. I certainly hope that you have business cards and that you have a website and that you're operating like a business, because if you're operating like a business, you'll be treated like a business. If you're not, you won't be, and that brings up the whole PSB, PSC issue.
Which we don't even want to get into because it's a nightmare.
Yeah, exactly. And we don't have the time to go into that discussion today, but it really is important to look at it like a business.
Okay, and I guess one of the other things that's already been brought up by one of the questions is about HST. Is there any tax strategies that you can provide? Obviously everyone who's earning over $30,000 has an HST or should have an HST account. Just let's start with that. Assuming if you're making over $30,000,
you better have one.
You better have an HST account, and you better be collecting that. But how can and obviously I need to make my remittances for HST, however that is, quarterly, monthly, quarterly, yearly, that I'm making those remittances. But is there any strategies that I can look at that's going to reduce my HST contributions I need to make?
Yeah. So first and foremost, if you're under $30,000, you probably want to be collecting GST anyways. So you want to register for GST as early as possible, because what a lot of people don't realize is that you make money on GST. So with the quick method, which is another method that's a big advantage for independent contractors, you're collecting 13%, but you're not remitting 13% back to the government. You're remitting back to the government 7.8% on the first $30,000 and 8.8% on everything over $30,000. So if you're under $30,000, you basically get to keep the difference between 13% that you collected and 7.8%. So that's a
Seems like a good deal to me.
Exactly, and For your end client, it's not a cost for them because most large businesses are going to be on the long method of GST. And the long method of GST is you take what you collected and you subtract what you paid. So for the end client, there's no cost to them because they pay it out, but it's an input tax credit that reduces how much they would have to then pay to the government. So
Right.
it's no cost to them at all. And the small guy who's on the quick method gets to keep a percentage of that. So that's where the big advantage comes in is first of all, if you're under $30,000, getting registered as quickly as possible. If you're over $30,000, then figuring out whether you want to be on the long method or the quick method. As I said earlier, it's 7.8% of the first $30,000. So that means they're making an assumption that you've spent a certain amount on GST.
Right.
And what we have to figure out is, have we spent that much or have we spent more than that? If we've spent more than that, then we want to be on the long method. But for most independent contractors, that's extremely rare because we're a very high margin business with very low costs. The largest cost that most independent contractors are going to have is their own salaries and wages, which aren't going to have GST and HST on them. So for that, it's typically best to be on the quick method. That being said, if you have a client that is outside of Canada, for example, US client who you're not charging GST to, it's not going to be better to be on the quick method. Because although 7.8% of zero is zero, it's actually going to be better for you to use the long method because zero minus a number is going to create a negative, which is a refund, right? And so
Can I switch back and forth every year depending on like where because again, some consultants their business is in Canada one year and then the next year they're doing business in the US. So can I switch back and forth?
Yes, but you have to make sure that you file the election, which is basically making the request with CRA on time. Because you can't change it retroactively. You can only change it proactively. So you can change year to year, but you basically have to know before your year happens.
So if I happen to start my fiscal year and I'm working in Canada and I'm not even thinking about this and then I go work in the US on my next contract mid my fiscal year, I can't make the change. But if I'm continuing to work in the US,
then you'll make the change at the end of the year so that your
for the next year.
Exactly.
Okay. And so is there any other thing like in terms of, as we're in this tax season that you think is advantageous to share with people now or something that maybe it's too late for next year, but something I should really be thinking about now for this fiscal year?
Well, I think the most important thing is really just hammering home this idea of thinking of yourself as an entrepreneur and trying to deduct everything and getting receipts and documentation. Although a credit card statement is not considered a valid source document as far as documentation with CRA is, it does give us a starting point to make sure that we're tracking all the transactions.
Right.
And that's why the addition of HubDoc is so important, is because it does allow you to link the transaction from the vendor to the bank statement so that if you're ever audited, you're audit proof. And that's what I love about HubDoc. But even if you're not audit proof, you at least can do the bookkeeping and get the transactions from the credit card and bank statement. So putting absolutely every expenditure you ever have on a debit card or a credit card, like cash is the most offensive four-letter word to the accountant. So eliminate that from your vocabulary. Put everything on a credit card or a debit card, preferably credit card because then the vendor is paying the cost as opposed to the independent contractor. Track all your expenses. Run it through some sort of benchmark analysis so that you can see how you're trending, because I guarantee you CRA has their own benchmark analysis that they're running to potentially flag you or to figure out whether you have been reasonable. And then, work with a professional who knows and understands your industry to make sure that you've maximized all the deductions that are specific to your field. And within our field, obviously, there's, the big ones, the largest deductions that most people are going to have is going to be their home office and their automobile, and then meals and entertainment. There is an issue right now with advertising, specifically business clothing. Once upon a time, we used to be able to deduct business clothing without any issues. Unfortunately, there was a court case fought and lost by a lawyer. The lawyer was claiming his suits, and he had quite a bit of, he was buying expensive suits, and he'd spent a fair bit on it. And prior to that, it had been accepted pretty much by CRA and the courts that business clothing, suits, dry cleaning was, and even personal grooming, haircuts was part of your professional image and legitimate. Unfortunately, he lost that case, and it's been the evidence that CRA has needed to be able to deny business clothing ever since. So in our company, we will allow clients to deduct business clothing if they really believe it's related to their business, with the giant caveat that there's a probability that CRA may disallow this expense. And the problem we have is that it's not a battle that people are going to fight again, because who's going to go up against CRA for $1,000, $2,000 worth it's not worth it. So unfortunately, the jurisprudence has been created by this lawyer who didn't adequately represent himself, because I'm sure he was a brilliant lawyer, but he wasn't probably a brilliant tax lawyer. Unfortunately, that case is there. CRA can reference it. They can and will reference it if they identify it. So that's one of the deductions that unfortunately has really gone by the wayside. But we still have the ability to do gifts through advertising, having your website, having business cards. So there's still other deductions that can go through the advertising account. And if you're on the more aggressive side and you really believe that your suits are related to your business and you're willing to roll the dice, we do allow that for our clients. I do personally claim my suits. I believe that they are legitimate. I only wear them for work.
You're not strolling around on the weekend in your suits?
I don't mow the lawn in my suits, and even if I have a wedding, which is pretty rare, I'm often buying a new suit just for that event that is specific for that. So I'm not very aggressive. I don't spend a lot of money on suits, but I do claim it, so I am aggressive from that standpoint.
Okay, great. And Courtney, do we have any other questions from everybody else on?
No, we're questioned out.
We're questioned out. How are we doing on time? We're a little long, aren't we?
A little over.
Yes. All right. Well, I think that's the end of the Facebook Live this month, but I think we'll be back next month with a new topic, and we look forward to hearing more comments. And again, reach out to Andrew if you want to take advantage of his deal on QuickBooks. And again, that's, what's your email address again? a.wall@ca4it.com, or message me through Facebook. Or message through Facebook, and Andrew can hook you up with that deal. And obviously, he's talked about the advantages of cloud accounting. So definitely take advantage of this. It's the cheapest price they're probably going to get for this year.
Absolutely. I don't think you'll find a cheaper price anyway.
And if you're looking for some information on your current corporation status, or setting up a business, or getting your HST in order for this year, again, reach out to Andrew. He can set you up a free consultation, give you some benchmarking on your organization, and put you into a position where you can get some tax advantages and maybe make, or at least save some money for next year.
Absolutely.
Great. Well, thank you so much, Andrew, for coming here. We really enjoyed speaking with you today.
Well, thanks for having me.